One man controlled the first billion-dollar corporation. One man influenced more than half of the American stock market. And twice, when the United States stood on the edge of collapse, the economy survived because J.P. Morgan said yes. This was not leadership. This was leverage. And the most dangerous part is this. The system he built never disappeared. It simply became invisible. You wake up and check your bank balance. You swipe a card. You take a loan. You invest for retirement. You trust that the system behind all of this is stable, regulated, and fair. But here's the truth most people never hear. You are not interacting with free markets. You are living inside a consolidated architecture designed long before you were born. A system where control matters more than competition, where scale beats innovation, where survival belongs to those who own the pipes, not those who flow through them. This is the same playbook that once ruled railroads, steel, and electricity. Today, it governs banks, platforms, asset managers, and entire supply chains. You think you are choosing a bank? In reality, you are selecting between branches of the same structure. You think risk is spread, but concentration has never been higher. This is not corruption. It is not conspiracy. It is efficiency taken to its logical extreme. The system rewards size. Size creates dependency. Dependency creates silence. And once a system becomes critical to the economy, it becomes untouchable, because breaking it would hurt everyone trapped inside. That is why the most powerful institutions are never removed. They are rebranded. They are regulated in ways that protect them. They are rescued when they fail. You do not escape this system by opting out. You already live in it. The only question is whether you understand how it works. In this story, you are not here to learn history. You are here to understand a machine that still decides your future. Because if you believe this system died with the robber barons, you are already exposed. In the next few minutes, I'm going to show you three things. First, how one private banker quietly replaced government decision-making during moments of national crisis. Not by force, not by law, but by necessity. Second, how consolidation stopped being a business strategy and became a survival requirement. Why companies that refused to merge were starved, isolated, and erased. And why this logic still governs modern finance, technology, and infrastructure. And third, the most uncomfortable truth of all, why breaking monopolies did not weaken the system. It made it stronger, more distributed, more protected. This matters because the system you live under today was not designed for fairness. It was designed for stability at any cost. When markets panic, this system does not ask for permission. It acts. When governments hesitate, this system fills the vacuum. And when things go wrong, it never pays the full price, because it has made itself too important to fail. Understanding this is not about outrage. It is not about ideology. It is about survival inside a structure that rewards those who see it early. Because once you understand the system, you stop asking why it feels rigged. You start asking where you stand inside it. And that question changes everything. To understand the system, you have to understand the man who believed in it. J.P. Morgan was born into privilege, elite education, European connections, unlimited access to capital. But his childhood was not powerful. It was fragile. He was sick, constantly isolated, pulled away from other children and locked into rooms with books, numbers, and balance sheets. At an early age, he learned one brutal lesson. The world is unstable, and weakness has consequences. Then came loss. His wife died only months after their wedding. No warning, no control. That moment mattered more than any deal he would ever make. Because from that point forward, Morgan did not chase wealth for comfort. He chased structure for safety. Money was never the end goal. Control was control over companies, control over industries, control over chaos. This is why he hated disorder more than competition. Why he believed fragmentation was dangerous. Why he saw consolidation not as greed, but as responsibility. To Morgan, unstable markets were not opportunities. They were threats. And threats had to be neutralized. This was not hypocrisy. This was belief. He genuinely believed that concentrated power was safer than scattered failure. That one firm in control was better than dozens collapsing at once. And once you see the world this way, the system builds itself. Not as a conspiracy, but as a solution to fear. Most people looked at the railroad industry and saw chaos. Too many companies, too many routes, Prices collapsing as competitors undercut each other just to survive. Morgan saw something else. He saw pipes. Railroads were not businesses to compete in. They were arteries of the economy. Whoever controlled them controlled trade, pricing, and survival itself. This is where the system truly began. Instead of fighting competitors, Morgan absorbed them. Weak rail lines were refinanced. Management was replaced. Costs were cut. Routes were merged. Competition did not disappear overnight. It was slowly suffocated. Once multiple railroads were folded into a single structure, price wars stopped. Stability returned. Profits followed. And here is the key insight. Stability attracted foreign capital. European investors poured money into American railroads because they looked safe again. Not innovative. Not fair. Safe. This process became known as Morganization. But it was not a tactic. It was a philosophy. Fragmentation was weakness. Consolidation was strength. Morgan did not just own railroads. He controlled boards. He dictated leadership. He decided who survived and who disappeared. And he made one rule clear. If a company wanted help, it surrendered control. This is what control the pipe really means. You do not need to own everything. You just need to own what everything flows through. Once you control infrastructure, competition becomes optional. And railroads were only the first proof that the system worked. Vertical control was only the first layer. The second was far more ruthless. Once Morgan stabilized an industry, he eliminated the field around it. This is horizontal control. Weak competitors were not allowed to recover. They were either purchased, absorbed, or slowly starved of capital. Banks aligned with Morgan stopped lending to outsiders. Rail access became selective. Suppliers followed the money. Companies that refused consolidation found themselves isolated. No credit. No favorable rates. No path forward. This is how markets die quietly. Not through violence. Through denial. Morgan understood something most investors never did. You do not need to destroy everyone. You only need to make survival impossible. This is why his influence went far beyond ownership percentages. He controlled boards of directors. He reshuffled leadership. He decided which executives stayed and which were removed. Corporate governance became a weapon. If a company came to him for rescue, the price was always the same. Total control, not advice, not partnership. Control. This method was so effective it earned a name, Morganization. But again, this was not branding. It was a system. A system where competition was framed as instability, where monopoly was framed as responsibility. To the public, this looked predatory, and it was. But to Morgan, it was necessary, because fragmented markets collapse, and collapsed markets threaten everything above them. Once an industry reached this stage, there was no going back. The field was gone, and the giant was ready to grow again. Railroads gave Morgan control over movement. Steel gave him control over production itself. At the center of this moment stood Andrew Carnegie. His steel empire was profitable, dominant, and perfectly built to be consolidated. When Carnegie decided to sell, there was only one buyer who mattered. Morgan did not negotiate like a merchant. He did not argue price. He did not hesitate. When Carnegie named his number, Morgan agreed instantly, because the price was irrelevant. What mattered was what came next. Morgan merged Carnegie Steel with its rivals and supporting firms. The result was U.S. Steel, the first billion-dollar corporation in history. This was not symbolism. It was immunity. At that scale, competition became impossible. Smaller steel companies could not undercut prices. They could not match distribution. They could not survive downturns. U.S. Steel controlled roughly 2/3 of American steel production at a time when steel and railroads formed the backbone of the entire economy. Here is the critical insight. Scale did not just increase profits. It absorbed risk. When demand fell, smaller firms collapsed. The giant endured. When regulators appeared, the giant negotiated. When labor pushed back, the giant waited them out. This is when consolidation stopped being aggressive and became defensive. Size was no longer about dominance. It was about protection. Once a company became large enough, failure was no longer an option. Not because it was efficient, but because its collapse would take the system with it. This is how giants are built, not to win markets, but to outgrow consequences. In the 1890s, the United States faced a problem it was not built to solve. There was no central bank. The dollar was tied to gold, and the gold was disappearing. Foreign investors lost confidence and demanded metal instead of paper. Gold reserves drained day after day. Markets panicked. At one point, the federal government held less than $10 million in gold. That was not a recession. That was a countdown. If the reserves hit zero, the nation would default. Congress moved too slowly. Public bond sales could not restore confidence fast enough. So, the government did something extraordinary. It called a private banker. Morgan assembled a syndicate of financiers and foreign investors. They offered gold in exchange for long-term government bonds. The deal was executed immediately, quietly, without congressional approval. Within minutes, the bleeding stopped. Markets stabilized. Confidence returned. America survived. But the lesson was irreversible. A private financial network had just rescued a sovereign nation. Not out of charity, out of leverage. Morgan made a profit on the bonds. But more importantly, he proved something dangerous. When institutions fail, power flows to whoever can act fastest. From that moment on, the boundary between public authority and private capital blurred. The state did not disappear, but it learned its dependence. This was not a coup. It was a replacement by necessity. And once a system proves it can save everything, it becomes indispensable. That is how financial power replaces political power. Not through elections, through emergencies. In 1907, the system cracked again. Banks failed, trusts collapsed. Crowds lined up outside branch doors, desperate to withdraw cash before it vanished. There was no safety net, no deposit insurance, no central authority ready to act. Panic moved faster than policy. Once again, the government hesitated, and once again, it turned to J.P. Morgan. Morgan did not issue speeches. He issued summons. The most powerful bankers in the country were called to his private library. The doors were closed, and then they were locked. Inside that room, Morgan made the math unavoidable. Some banks would fail. Others could be saved, but only if capital moved immediately. Money was pooled. Rescues were prioritized. Weak institutions were sacrificed to protect the core. Negotiations dragged into the night. No one was allowed to leave. By morning, an agreement was forced. With presidential approval, the Treasury added funds to the rescue. Confidence returned. Withdrawals slowed. Collapse was avoided. The newspapers called it heroism. But the truth was more uncomfortable. One private individual had just coordinated a national bailout, not through law, through authority earned by scale and fear. This moment changed everything. It exposed how fragile the financial system truly was, and how dependent it had become on a single center of gravity. The crisis ended, but the realization did not. A system that requires one man to survive cannot be allowed to exist again, and that realization would soon create something new. Public patience finally snapped. Newspapers turned hostile. Politicians smelled danger. Hearings were called to expose the invisible architecture behind Wall Street. For the first time, the system was dragged into the light. The question was simple. How could so much power rest in so few hands? Investigators uncovered overlapping boards, private agreements, and financial pipelines that connected nearly every major institution. It was not illegal. It was structural. The public wanted punishment. What they got was redesign. Lawmakers understood something critical. They could not destroy the system without collapsing the economy with it. So they did something smarter. They centralized it. Out of fear and necessity, a new institution was born, the Federal Reserve. Its mission was stability. Its promise was independence. But its function was continuity. The system Morgan built did not disappear. It was absorbed, standardized. Protected by law, power moved from one man to an institution, from private rooms to official buildings. This was the upgrade. The chaos of relying on a single banker was removed. The logic of consolidation was preserved. Markets were safer. Failures were managed. Rescues became policy. To the public, this looked like reform, and it was. But it was also preservation. The same incentives remained. Size still mattered. Failure was still unacceptable at the top. Morgan did not lose. He proved the model so effective that the nation adopted it. The man faded. The system stayed. And once embedded into law, it became permanent. The names have changed. The tools are digital, but the system is identical. Where railroads once controlled movement, platforms now control access. Where steel once controlled production, data now controls value. You do not pay tolls at a gate. You pay them through fees, spreads, subscriptions, and invisible margins. The logic is the same. Control the pipe, eliminate the field, grow until failure becomes unacceptable. Today, consolidation is framed as innovation. Mergers are framed as efficiency. Bailouts are framed as stability, but the outcome never changes. Fewer players, bigger balance sheets, deeper dependency. When markets shake, the largest institutions are rescued first. Not because they are virtuous, because they are essential. When regulators step in, they do not dismantle giants. They supervise them, because dismantling them would break everything downstream. This is why modern power feels invisible. You never see the room where decisions are forced. You only see the results. Prices move together. Credit tightens everywhere at once. Risk spreads upward while losses flow downward. You are told this is complexity, that it cannot be helped. But complexity is not an accident. It is protection. The more interconnected the system becomes, the harder it is to challenge. Because no single failure can be isolated, this is the Morgan system perfected, distributed, regulated, permanent. Same playbook, different century. And if you think this system does not affect you, that is proof that it is working. This is the part no one likes to hear. You cannot escape this system. The choices were removed long before you arrived. You have 3 options. You can accept it and follow the rules as they are written. You can resist it and pay the cost of friction and instability. Or you can position yourself with awareness, understanding where power flows and why. This is not about rebellion. It is about clarity, because the system does not punish ignorance. It exploits it.